Hi, Investor Nation and Tasty Nation. With volatility in the markets heightened right now, I think it's a great opportunity to use options to take advantage of that heightened volatility. I'm going to walk through 4 sample trades that we could put on right now that could take advantage of the heightened volatility. And these trades all happen to be bullish. Tom and Tony answered a great question about this topic today on Confirm and Send.
If you think certain stocks are getting inexpensive and you want to apply the most capital efficient, high implied volatility, long delta strategy, what would you do? What an appropriate question for today.
I mean, if you have the capital, I think a naked put right now with that assumption would be the way to go. Volatility's high probability trade. That would be the way I would set the hook, at least at the beginning.
My 3 to address stocks getting inexpensive, capital efficiency, high IV, long delta strategy. You could start with a naked put. That's number 1. Number 2 would be the naked put and a short call spread, which is a Jade Lizard. That would be number 2. The only difference between those two is that one has a short call spread and the other one doesn't. And then number 3 would be a short put spread where you sell a naked put, but you just buy it further out of the money put. Okay. Mm-hmm. And to us, those would be the 3 that we would use here. Okay.
Yep.
Okay. So we just heard from the experts. Their 3 favorite strategies are the short put, the Jade Lizard, the short put spread, and I'm going to add on my own 4th one, which is the covered call. So I'm going to show sample trades for all of those. So here I am in my trading platform. For the first trade, I'm going to do a short put in Robinhood. Robinhood's on its butt right now. Volatility is heightened. And using the Tasty Trade mechanics, I'm going to go out to 53 days to expiration, which is the March expiration cycle. I'm going to look for around the 30 delta on the put side, and around 27.5 delta is the 11 put. So I'm going to sell the 11 put. So the mid price here around $1.30. It's only taking up $379 in buying power, and I'm getting a credit of $1.30. So my return on that capital is really high there, almost 30%. So Robinhood being on its butt, I don't mind getting long here, and I don't mind getting long down at the 11 strike. So that means I'm willing to take shares at $11, even though Robinhood's trading up at 13 right now. So the probability of profit on this trade is 75%. That's a great probability. My max return is just the credit I receive. It says 123 here. That depends on what price you get filled at. The max loss here is $977. That's if Robinhood goes to 0 in the next 53 days, which is a very low probability. And this is a bullish trade because I want Robinhood to either go up a little bit or go up a lot or stay where it is right now. But I'm actually protected all the way down to my break even of $9.77. So selling a put is a good way to get long a stock that you want to get at a cheaper price. So even though Robinhood's trading up at 13 right now, I can actually get my break-even price down to $9.77. This is a good deal, as long as you're bullish on Hood. Okay, next example is IWM, which is the Russell 2000. It's the ETF made up of 2,000 small cap companies, so it's really diversified. It's a little bit different than getting into just a single company like Robinhood. There's a lot more diversification here. And if I wanted to just get long the market right now, because it's taken a bit of a hit lately, this could be a good opportunity to get long the market using IWM, using a Jade Lizard. So with the Jade Lizard, I start off with the short put, just like I did in my first example. So maybe around the 30 delta, the 190 strike. I'm selling the 190 put. I'm collecting about $5.50 there. So that's how much I have to work with. The credit I'm getting on the put side, I can use some of that on the call side to sell a call spread. So say I go also to around the 30 delta on the call side, sell maybe the 213, and maybe I'll go 3 strikes wide. So sell the 213, buy the 216. So I'm selling a call spread $3 wide, and the total trade, I'm doing it for a credit of $669. So as long as the credit that I got on the put side is greater than my $3 wide spread here, which it is, because remember the credit I got on the put side was 5.5, then I have no risk to the upside. So this is a bigger trade than the last one I showed. The buying power required for this trade is $5,900. So I wouldn't do this in a really small account. I would want at least $20,000 or $30,000 in my account to do this trade, because I have to be willing to get long IWM at my break-even price in case things go really wrong. The probability of profit here is 79%, so it's a high probability trade. My max loss is $18,000. That's if IWM goes to 0 in the next 53 days, and that would mean the whole market goes to 0, which I'm pretty sure is not going to happen in the next 53 days. My break even is down at 183. So even though IWM IWM is trading up at almost 200 right now. I'm effectively getting long IWM. That's my break even down at 183. So again, this is a good deal to get long the market at cheaper prices. I'm taking advantage of the heightened volatility to take in this credit to improve my probability of success and get a break-even price way down at 183.58. So that's way down here on the curve. Okay, so that's the Jade Lizard. Now for my next example, I'm going to do SPY. The chart for SPY looks almost identical to IWM. It's basically the market. SPY is the market, and so is IWM. IWM, the Russell, and SPY, which is the S&P 500, are basically the same thing. IWM has 2,000 stocks. SPY has 500 stocks. So these are highly correlated, and I wouldn't want to put a trade on in both IWM and SPY at the same time because of that correlation. Okay, so again, I'm going out to 53 days, and in this case, I'm going to sell a 30 delta put in SPY. So it's the 414 strike. And then I'm going to buy a strike further out of the money to define my risk. Now, how wide you want to go on this is entirely up to you. The studies show that maybe $3 or $5 is probably the narrowest you would want to go on these. Personally, I like to go out $10 wide at least. And the reason for that is because I know my max loss on a $10 wide spread is going to be $1,000 minus the credit I received. So I talked about that in my futures options video. So make sure you check that out if you haven't seen that video. Okay, so here I am. I'm selling the 414 put. I'm buying the 404 put, $10 wide. I'm collecting a credit of, I'll put in a mid price here, almost $2. There's my buying power right there. I have to put up $1,000 to do this trade because that's the maximum I can lose on it. But even if I lose on this, I'll still keep that credit of $197. If I look at my probability of profit here, it's 75%. So again, another high probability trade. My max loss is actually 1,000 minus the credit I'm receiving. So it's actually $816. So my risk is much, much lower on this trade than selling a naked put or doing a Jade Lizard. And that's because I'm defining my risk with that long put. Now, if I didn't like this credit I was receiving here, I could just move the strikes around a little bit. If I wanted a higher credit, I could go closer to the money. So I could bring my short into the 420 strike and bring my long into the 410 strike. And that is still $10 wide, but now my mid price here is trading for higher than $2. And the trade-off that I've made here is my probability of profit has gone down to 70%, but I'm collecting a higher credit. So you can always fiddle around with the strikes there and move them to what makes you most comfortable with your own personal risk to reward. So there's always a trade-off with the credit you receive and the probability of profit. Okay, and that brings me to my last example of a bullish trade today, which I'm going to do is a covered call. And I'm going to use Peloton as an example. If you look at a chart of Peloton, Peloton has been absolutely hammered. It had a maximum price of over $150 a while back. And right now it's trading way down at $29, almost $30. So if now's not a good time to get long Peloton, I don't know when is. This is assuming, of course, that Peloton is not going to go out of business in the next 53 days. So I'm going to turn on my strategy builder here. And to do my covered call, I'm going to buy 100 shares of Peloton. So it's currently trading at 29.8, but I want to buy those shares at a discount. That's what a covered call allows you to do. So if I look at around the 30 delta call, 53 days to expiration is around the 40 strike. So I'm going to sell the 40 strike for around $2. So that gives me a $2 discount on the stock. Now look at the buying power I have to put up to do this. It's only $1,000 I have to put up to buy 100 shares and sell a call, even though the notional value of the stock is $2,900. So there's a bit of leverage involved here. I don't have to put up the full amount. And let's look at our probability of profit. Now here's the trade-off we're making with a covered call. The probability of profit here is only around 56%. So it's much lower than the other three examples I just showed you. And that's the trade-off you make when you buy a covered call versus selling a put. The covered call, you can make more. The max return here is $1,200. That's if Peloton goes up and blows through my 40 call. I would receive the maximum profit. My shares would get called away at a price of $40 a share, and I would receive the maximum profit of $1,200 at expiration, which is March 18th. Now, the max loss here is almost $2,800. That's if Peloton goes completely out of business in the next 53 days. So it's not a big chance of doing that, but you got to be careful with this. You don't want to have on a whole bunch of trades in your account. And if even one of those companies goes out of business, it's going to ruin your account. So you got to be careful with the type of stocks you pick. And if you weren't comfortable getting long any stock, just stick with IWM or SPY, which I just showed you. Okay, my break-even price is down at $27.95, almost $28. It's because of that extra credit I'm taking in with selling the call. It gives me an extra buffer so that if Peloton goes down a little bit or stays where it is now in the next 53 days, I'm protected down to around 28. Okay, so that's 4 bullish trades. Let me know what your favorite trade is to put on for a bullish position and what stocks do you like to be bullish in? And stay tuned for a future video where I'm going to show some bearish trades. Thanks for watching.